For Chapter 9 and 10, we will continue the budgets topic. In Chapter 9, Flexible Budgets and Performance Analysis, we will learn how budgets can be adjusted so managers can compare budgets to actual results. Learning Objective 1 is to prepare a planning budget and a flexible budget, and also understand how they differ from one another. Let's first take a look at the static planning budget, and we will talk about the deficiencies of this type of budget. Static budget is a planning budget. It's prepared before the period begins, and it's valid for the planned level of activity. If the actual level of activity is different from what was planned, it will be misleading to evaluate performance by comparing actual costs with the static, unchanged planning budget. So comparing static planning budgets with actual costs is like comparing apples and oranges. Let's take a look at the example. Larry's lawn service provides lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all of the lawns are similar in size, Larry felt that the number of lawns mowed in a month would be the best way to measure overall activity for his business. Let's take a look at his budget. This is Larry's planning budget. It's based on the planned level of activity, 500 lawns mowed. Larry identified 7 major expenses for his business. Also, he estimated the cost formula for revenue and expenses in terms of the number of lawns mowed. Let's see here. We use Q to indicate the number of lawns mowed. For revenue, the formula here, 75 multiplied by Q. So we can get the total revenue in dollar amount, $75 multiplied by 500, and you'll get $37,500. Expenses, wages and salaries. This is a mixed cost. We have fixed cost here, $5,000, plus variable cost, $30 multiplied by Q. So wages and salaries, $20,000. Gasoline and supplies, $9 multiplied by Q. This is a variable expense. So the total here, $4,500. Equipment and maintenance, $3 multiplied by Q. So this is a variable expense as well. Total here, $1,500. For office and shop utilities, office and shop rent, equipment depreciation, and insurance. Those 4 expenses are fixed expenses. They are constant, regardless of how many lawns are mowed. Total expenses here, $32,500. We subtract the total expenses from total revenue, and then we can get net operating income, $5,000. Again, this is based on planned level of activity, 500 lawns mowed. Now let's take a look at Larry's actual results. This is Larry's lawn service actual results for the month of June. Actual number of lawns, 550. For revenue, actual revenue earned, $43,000. And Larry has incurred actual expenses here. Total expenses, $36,550. And net operating income, $6,450. If we want to compare Larry's actual results with a planning budget, this is a table. This column shows revenue cost formulas. Planning budget is prepared based on planned level of activity, 500 lawns mowed, and followed revenue cost formulas. For actual results are based on actual level of activity, 550 lawns mowed. It shows actual revenue earned and expenses incurred. Please note here, actual results are not prepared following revenue or cost formulas. They are actual revenue earned and actual expenses incurred. The last column shows variances. The differences of revenue and each expense between planning budget and actual results are calculated as variances. If actual revenue is greater than budgeted revenue, it's a favorable variance, so we use F to indicate it. If actual costs are less than budgeted costs, it's a favorable variance. If actual costs are greater than budgeted costs, then that's unfavorable variance. Since these variances are unfavorable, can we say Larry has done a poor job controlling costs? And because of this favorable variance, can we say Larry has done a good job controlling costs? We cannot actually answer these questions because comparing planning budget with actual results is like comparing apples to oranges. Levels of activity are different for these two budgets. Actual activity is more than planned activity. So if actual level of activity is higher, of course, the variable costs should be higher. We cannot jump to the conclusion saying if Larry has done a good job or a poor job controlling costs. Then it raises an additional question. How much of the cost variances are due to higher activity and how much are due to cost control? To answer this question, we need to flex the budget. Let's take a look at flexible budgets. A flexible budget provides estimates of what revenues and costs should be for any level of activity within a relevant range. When used for performance evaluation purposes, actual costs are compared to what the cost should have been for the actual level of activity during the period. This enables apples-to-apples cost comparisons. It helps managers control costs and improve performance evaluation. To flex the budget, we make two assumptions. First, total variable costs change in direct proportion to changes in activity. Second, total fixed costs remain unchanged within the relevant range. These are two cost behaviors we've learned in Chapter 1. Now let's prepare a flexible budget for Larry's lawn service. This is Larry's flexible budget based on actual level of activity, 550 lawns mowed. We can calculate revenue and variable expenses and mixed expenses following revenue cost formulas. For fixed expenses, keep in mind they are constant. This is a complete table. For revenue, we use 75 multiplied by 550. And for wages and expenses, 5,000 plus $30 multiplied by 550. And gasoline and supplies, $9 times 550. Equipment maintenance, $3 times 550. And you can see for fixed expenses, they are the same. Total expenses, $34,600. And net operating income, $6,650. Next, we will calculate and interpret activity variances. If we compare planning budget revenues and expenses with flexible budget revenues and expenses, the differences are called activity variances. Let's calculate activity variances for Larry's lawn service. This is a table to compare Larry's flexible budget with a planning budget. Please keep in mind, the only difference between planning budget and a flexible budget is the level of activity. Planning budget is based on the planned level of activity, 500 lawns here. Flexible budget is prepared for the actual level of activity, 550 loans here. For revenue, variable expenses or mixed expense here. Both budgets follow the formulas, and we can get numbers here. For fixed expenses, they are constant. So you can see, regardless of how many loans mowed, they are the same. Here, revenue in the flexible budget is 10% higher than the planning budget because the revenue varies proportionally to changes in the activity level. The higher activity level results in a favorable activity variance for revenue. For expenses, wages and salaries are mixed expenses. It incurs unfavorable activity variance. Gasoline and supplies, equipment and maintenance, they are variable expenses. Expenses in the flexible budget also increased by 10% compared to planning budget. The higher activity level results in unfavorable activity variances for these two variable expenses. For fixed expenses, they are constant. Here's one question. If activity and revenue increase by 10%, will net operating income increases by 10%? If you haven't taken a look at the net operating income numbers of the planning budget and the flexible budget in the previous slide, think about it. The answer is B, more than 10%. Why? Here, activity and revenue increases by 10%. Variable expenses increased by 10% as well. But for wages and salaries, it's a mixed expense. The expense in the flexible budget increases by less than 10% because of the fixed component. And for fixed expenses, they are constant. They are not sensitive to the change of level activity. So total expenses increase by less than 10%, and net operating income increased more than 10%. If you calculate 1,650 divided by 5,000, it's around 33%. So net operating income increased by 33%.